Happy New Year, everybody. I am joined by my good friend Tyler Crowe. We are going to talk about some of our favorite investment ideas for 2024. Now, a lot of people try to find bargains in the stock market, and that can be definitely a good way to invest. Tyler's definitely one of them. But it's also a smart idea not to ignore the stocks that have done well. So, we're each going to talk about one of our favorite stock that is up by, let's say, around 50% or more in 2023, and why we think it could still be a good opportunity. Before we dive in, I'll pass the mic to Tyler in just a second. Before we dive in, please take a minute, click subscribe to my channel if you don't already, and take a minute to check out the link you see on your screen. It's the best way to support this work we're doing, and you can get the top 10 stocks to buy right now from the Motley Fool. So, Tyler, what stock on your agenda or on your watch list did really well in 2023, but you still like it?
Well, it it had a fantastic 2023, but the past 5 years have not treated it as well. I'm talking about Parks, Hotels, and Resorts. This is a hospitality REIT that uh, uh, owns and operates a lot of hotels that I would call like either it kind of straddles. It's either destination resorts or central business travelers. They own a lot of things like the Hilton on Waikiki Beach, the Hilton in Midtown Manhattan, as well as the Waldorf Astoria in Orlando, just to give you an idea of like kind of the properties that we're talking about here. And so it's like a tale of two businesses all rolled into one, because on the travel leisure resort side, the business has been doing quite well, actually. Aside from Hawaii, which is still down since pre-COVID times, mostly related to Japanese tourism in the in Hawaii, excuse me. It hasn't quite gotten back to 2019 levels, but continental United States, excuse me, a little bit of a Christmas time cold here. Continental Florida has been like a very good market for them, and a lot of the destination resorts in the lower 48 have been very good. But Central Business District uh, hotels have been awful for them, and it's been one of the weak points for them. So much so that back in June, they actually turned in the keys for two of its hotels, both Hiltons in downtown San Francisco. And that sounds awful. Excuse me, my goodness. That sounds awful. But, the idea being like they kind of looked at it and said, look, we're losing money on this anyways. If we just turn in the keys, we'll actually make more money. We can, we'll walk away from the debt and not have to pay interest on it. And it actually, we'll have a lower debt to EBITDA without really even sacrificing any profitability. And so, as much as the market seems really focused on this idea of like, oh my goodness, they're defaulting on debt, it actually works out for them pretty well. And if we look at parks, hotels, and resorts today, they have a dividend yield above 8%, and they currently trade for less than book value. And so there's part of me that says, I think even though it's up 50%, it's still down a lot from over the past 5 years. And there's a possibility that, this 50% run that we saw in 2023 may not be over because it's still pretty cheap.
Yeah, I mean, I'm a big fan of the hotel space in general right now. I think it's kind of, there's a lot of pessimism surrounding it as we head into 2024. And I know for a fact that, I'm a vacation homeowner. The vacation rental market has dipped after the post COVID surge in demand that we saw in, say, 2022. But, high end hotels are still very much in demand. People are still kind of, if there's one lasting effect of COVID in the hotel space, it seems that people are willing to splurge more. People want to treat themselves nicely because who knows when you're going to get locked down again is kind of the attitude it seems.
Yeah. The one
So
downside being, though, like we were saying, it's like there's just a lot less business travel. And so that seems to be the downside. Like, so if you're a leisure related hotel, you're probably doing pretty good. But if you're reliant on business conferences or, just basically like daily travel of consultants coming in and out, yeah, that's just not as good.
yeah, and no, that's very true. And I mean, it sounds like Park Hotels has some exposure to that. I mean, I like you mentioned the Hilton in Midtown Manhattan. I've stayed there for a conference before. So, I mean, it looks like they have some exposure, although that's not the primary focus, right? Okay. So, speaking of Manhattan, the one that I like that's gained a lot is an office REIT. And Tyler, you might be kind of scratching your head when I say office REIT and gain, because the subsector has not been performing well. Just to give you some numbers of companies I follow, City Office REIT is down 22% in 2023. A company called Orion Office, which was the spin out from Realty Income of its office properties, dropped by 28% last year. Um, so, as a whole, office REITs haven't been doing well. One in particular that has done well is Empire State Realty Trust. And I'm bending our 50% rule a little bit. They produced a 46% total return in 2023. But with that kind of outperformance compared to the rest of that group, it seemed worth including. Um, and so, why is this outperforming every other office REIT for the most part? A couple reasons. One, just tremendous execution when it comes to leasing. As far as major cities go, New York has been more of a leader in the return to office, I would say. When you compare it to, say, San Francisco, where Tyler just mentioned, the market's not doing too well for commercial real estate. Um, in Empire State's case, almost 92% of its Manhattan offices are leased. And before you say, well, wait, they're long-term leases, this will kind of work itself out as people reduce their office footprint. That's up 250 basis points year over year. So they're doing a great job of leasing up their vacant space. They also have a lot of retail properties. Pretty much every building in Manhattan is street level retail. And they also have been building out a multifamily property in Manhattan as well that's 97% leased. Number two, they have a much better balance sheet than most other office REITs. The big fear with office REITs these days is that they are not going to be able to refinance their debt, right? Tyler, you and I have talked about this on the show before. In Empire State's case, that's not as much of a concern. They have 354 million in cash on their balance sheet. This is about a $2 billion market cap REIT, and 850 million in untapped credit. All their debt's fixed rate, less than a 4% average interest rate. And the coolest part is that they can pay off their 2024 and 2025 debt maturities right now with their cash on hand if they needed to. So they do not have to refinance if they don't want to. They will if their terms are correct, but that's not as big of a concern as with other office REITs. And last but certainly not least, Empire State owns the observatory on top of the Empire State Building. I've been there several times in my life as a child growing up in New Jersey. That's a must do. Um, it's a really cool business because, unlike other office REITs, it allows them to extract a lot of money out of a very little part of their square footage. It's still one of TripAdvisor's must do American tourist attractions. It accounts for roughly 25% of Empire State's net income, even though it makes up about 1 to 2% of its total square footage of its portfolio. It's high margin revenue. It's an absolute cash machine, a 75% operating margin. And they just completed, right before COVID hit, they completed a massive renovation of the space. It's absolutely beautiful. And they couldn't have timed it worse because, they renovated the space and it was essentially shut down for 2 years. But it now is a cash machine again. They've been buying back stock aggressively, taking advantage of the kind of mispricing, market's pessimism over the past couple of years. But Empire State's one that I was kind of in wait and see mode for a while. But the numbers show that they're back on track and doing much better than the competition.
What's a little surprising, I was just kind of looking at a market screen while we're doing this too. The other, I guess you could call them prestige New York office REITs, have actually done pretty good too, at least in 2023. SL Green and Vornado Realty, both, they were up 35 and I think 34 and 41% respectively. And so but to your point, right now, was it, Empire State has a net debt to EBITDA of about 5.5, whereas both Vornado and SL Green are touching double digits right now. And there's a lot of kind of, I think, a little bit of optimism baked into SL Green and Vornado relative to Empire State. And so if there's one of these, it's probably in a healthier position. It's certainly Empire State. You know, 1 year returns, a lot of things can happen. I mean, you look at the other ones, they're pretty cheap, but they're cheap for a reason.
Yeah, and I mean, Empire State's still like just under $10 a share right now. This was a $15 stock pre-COVID, so it's not quite where it was. And like I mentioned, there was a massive buyback that took place, which should even help long-term value more. And I'm really happy that Tyler doesn't completely disagree with my pick. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.